This video covers accounting for revenue. We will go through revenue recognition rules. We will go in detail into the journal entries and T accounts related to revenue accounts. And we'll briefly talk about the disclosure rules for revenue. Disclosure is what's after the financial statements in the footnotes. But first, I want to show you this picture. Recall that revenue is the income that a company earns from selling goods or services in its primary operations. Here, Elmo and Grover have started a lemonade stand, and they're selling lemonade to this blue monster with the pink beard. This picture is important because it captures the exact moment that Elmo and Grover's lemonade stand earns 25 cents of revenue. Elmo and Grover can recognize revenue at this instant. Why? Because they are delivering the lemonade to the customer. They have satisfied their performance obligation. There's one other thing I wanted to mention about this picture. Notice that the blue monster with the pink beard is not providing any cash to the lemonade business right now. It's still okay, even though they're not receiving cash, for Elmo and Grover to recognize revenue at this instant. That's because they have earned it. As long as they can be reasonably assured that the blue monster will pay eventually, they may recognize the revenue. And so here are the official criteria for when it's okay to recognize revenue. In reality, revenue recognition criteria are about 156 pages of text, but I've boiled it down into two basic rules. A company can recognize revenue when they have satisfied the performance obligation. So in this instance, think of Elmo and Grover delivering the lemonade to the blue monster. They've earned it because they've satisfied their performance obligation. The second criteria is that the company must be reasonably assured to collect payment. This is to make sure companies are only dealing with customers who are likely to pay them. So think of the blue monster being of sound credit quality and pretty reliable to make payment. Once these two criteria are met, a company may recognize revenue. And when I say recognize revenue, what I mean is that a company can credit the revenue account on the income statement. That's what I mean when I say recognize revenue. There are different journal entries that companies record to recognize revenue. And these journal entries depend on when is cash received relative to when the company recognizes the revenue. So is the company recognizing revenue before they receive cash? So think of Elmo and Grover and their lemonade stand. They earn the revenue before they receive the cash. Is the company recognizing revenue at the point of sale or simultaneously when they're receiving cash? Or is the company recognizing revenue after they've received the cash? So the customer prepays, and then later the company satisfies its performance obligation. First, let's go through an example of where a company recognizes revenue before receiving cash. And for this arrangement, we're going to talk about the example of Newmont Mining Company. Newmont Mining is a gold mining company based out of Denver, Colorado. Newmont mines dirt out of the ground. They refine the dirt into gold. And then they sell the gold bars to a bank. They deliver the gold bars to a bank, and then later the bank will pay them for the gold bars. And so let's talk about the first activity in Newmont's revenue cycle. The first activity is that Newmont delivers $1 million worth of gold to the bank. The bank has not paid yet, but Newmont has satisfied its performance obligation, the delivery of the gold. And so Newmont can recognize revenue. Here you see the credit to the revenue account for $1 million. Since they have not received the cash yet, they cannot debit the cash account. The debit in this instance is to accounts receivable, another asset account that represents the customer needs to pay Newmont. Newmont has a receivable from the customer. The final activity in this transaction is that the bank eventually makes the $1 million payment to Newmont. When the bank eventually pays, they are satisfying their accounts receivable. And so we credit the accounts receivable account for $1 million, reducing it to zero, and we debit cash, because Newmont is finally receiving the cash from the bank. Now let's look at the accounts receivable T account in detail. Accounts receivable is an asset account, and so it has a normal debit balance. The beginning balance of accounts receivable is in the debit column. When the company makes more sales but has not yet received the cash, they increase the accounts receivable account with a debit. So this revenue recognized box represents sales made on account where the customer hasn't paid yet. When the customer pays and they receive cash, this is a credit to the accounts receivable account, reducing it. Another possibility is that the customer is not of good credit quality and doesn't pay. In this instance, if the customer defaults, we'll also reduce the accounts receivable account. And we'll talk more about this when we talk about accounts receivable. Finally, you get the ending balance, which is again a debit. Another way to explain this T account would be to say you take your beginning balance plus the revenue recognized on account minus the cash received minus customer defaults equals the ending balance. Here is a kind of small but nice picture of Newmont's balance sheet. And this is just the current assets section of the balance sheet. You can see that the second asset is called trade receivables. That's what Newmont calls accounts receivable. And so if I were to tell you what this balance means, it says 373. And on the top of the column it says in millions. You see that? In millions. And so it's $373 million. What this means is that as of December 31st, 2019, Newmont has sold $373 million worth of gold, and they're still waiting to collect that money, hopefully sometime during 2020. One exercise you can do is think of other companies that might have the arrangement where they earn their revenue before they receive their cash. See if you can find some more examples of those types of companies. Next, we'll talk about the example where payment is received at the same time revenue is recognized. Payment is received at the point of sale. A great example for this type of transaction is Target. And this will be a quick example. Suppose you go to Target and you want to buy some Tide Pods so you can do laundry. So you go to Target, it costs $15. You check out at the checkout, you hand the person $15, and they let you walk out of the store with the Tide Pods. Well, they've received cash and they've satisfied their performance obligation at the same time. Note that the performance obligation is letting you walk out of the store with the Tide Pods. And so there's a credit to revenue for the recognition of revenue and a debit to cash. Because we're not waiting to receive the cash, we receive it right away. Finally, we'll talk about an example where revenue is recognized after receiving cash. And for this arrangement, we'll talk about Southwest Airlines. So you go onto the Southwest Airlines website and you buy a plane ticket for $200. You give Southwest $200 of cash. They now have $200 of cash. Have they earned it yet? Have they satisfied their performance obligation? They have not. And so while Southwest gets to debit the cash balance for $200, the credit cannot yet be to revenue. The credit is to a liability account called deferred revenue. Sometimes this is also called unearned revenue. This is a liability account because it's an obligation. Southwest has an obligation to fly you to your destination. The next activity is that you'll either take the flight using the ticket or your right to air travel expires because, for example, you missed your flight. So once Southwest has satisfied its performance obligation in one of these ways, they can now credit the revenue balance, recognizing revenue. And so the journal entry when the customer uses the ticket is a credit to revenue and a debit to deferred revenue, reducing deferred revenue to zero and recognizing revenue on the income statement. Let's take a look at the deferred revenue T account. Deferred revenue is a liability, so it has a credit beginning balance. When the company receives more cash but has not earned it yet, they credit the deferred revenue account for that cash received. When they satisfy their performance obligation and recognize the revenue, they debit deferred revenue for the amount that they've earned. Then the ending balance is again a credit. Another way to describe this T account would be to say you begin with your beginning balance as a credit, plus the cash that you received but haven't earned it yet, minus the revenue that you earned, equals your ending balance. See if you can think of some other companies that receive cash before they earn revenue. Here is the Southwest Airlines balance sheet excerpt. And so the section that's important is this section here, the liability section. And you can see there's a liability called, see if you can spot it. It's called the air traffic liability. The air traffic liability is what Southwest calls deferred revenue. At December 31st, 2019, the air traffic liability is 4457. And since this is in millions, that's $4,457,000,000 of deferred revenue as of December 31st, 2019. What does that mean? That means that sometime during 2019 probably, customers paid Southwest a ton of cash. Southwest got $4.5 billion in cash, and they haven't flown those people to their destination yet. And so they've got this obligation that they're showing on their balance sheet. Finally, we'll talk about disclosure rules for revenue. Disclosure is what happens after the financial statements, in the footnotes, and it helps investors interpret the financial statements. This group of people is the Financial Accounting and Standards Board, or the FASB. And they contend that the usefulness of the financial statements, which we're learning all about, depends on the user's understanding of the accounting policies that go together to create the financial statements. And so what is required for the company to disclose to help users understand the accounting policies? The FASB requires that companies disclose the following. First, companies must disclose their accounting policies for recognizing revenue. What are the general rules that the company uses to decide when it's okay to record a credit to revenue? Second, what are the significant judgments made by management to make that determination? So where does management have discretion in timing or amount of how much revenue to recognize? And so those are required to be disclosed. So to recap, in this video, we discussed the revenue recognition criteria. There were two criteria. First, a company must satisfy its performance obligation. Second, a company must be reasonably assured to collect payment. Once both of those criteria are met, the company can credit revenue, recognizing revenue. Then we learned about the revenue recognition journal entry. And this depends on when cash is received relative to when revenue is recognized. Revenue is recognized with a credit, and depending on when cash received, the debit account could be deferred revenue if the customer prepays, cash if the transaction is simultaneous, and accounts receivable if the customer has not paid yet, even though we've satisfied a performance obligation. Finally, we talked about the disclosures requirements. Companies are required to disclose their specific policies for how they recognize revenue and any significant judgments that go into the recognition of revenue by management.